what the heck is going on with builders offering super low interest rates? Offering 4.25% 30-year fixed rates. How are they doing? Hey everybody, it's John King. It is Friday, the 22nd of September, second day of fall, and I got a lot to update you on today. I'm actually headed out of town. My son has a water polo tournament, so you're catching me in day off mode, but don't try and take any days off when it comes to keeping you updated on what's happening with the market. So big week we just finished, or are finishing. Federal Reserve had their big meeting they do every 6 weeks, and they met on Tuesday and Wednesday. Everybody thought that they weren't going to raise interest rates, and the good news is they didn't raise interest rates. So happy to hear that, but they actually caused interest rates to go up. And here's why. Because the Federal Reserve doesn't control mortgage rates. You've heard me say this time and time again. But what the Federal Reserve does control is short-term rates, money that's loaned specifically overnight between banking institutions or a bank borrowing money from the federal government. So how does that control mortgage rates? Well, it's kind of the trickle-down effect, because if banks are paying more for money they're borrowing overnight, then they're going to end up charging more money for loans that they're going to keep for the long term. That's an oversimplified way to look at it, but the Federal Reserve's outlook on what they're doing with short-term rates impacts what mortgage rates do, because it basically follows in the same direction. And so what the Fed is thinking influences how the rest of the market is thinking. And the Fed kind of threw us a curveball, because the Fed we had believed, the industry, the markets had believed, the Fed was going to start lowering interest rates pretty soon. And they were talking about maybe one more rate increase, but clearly once that rate increase was done, they're going to have to start lowering interest rates sometime in the near future. Or so we thought. Now don't get me wrong, rates will go down, but the Fed made it super clear they are in no hurry to lower interest rates. And as a matter of fact, their specific language is something along the lines of, we're going to keep rates higher longer than anybody has expected. And that scared the markets. What does this mean to you? Well, first of all, it means that mortgage rates are pushing mid to high sevens. Like 7.25, 7.5 was about the high that we had seen previously. We're pushing past that. We'll see what the market looks like today and Monday, but the bottom line is it is definitely pushing rates to the highest levels that we've seen in 28 years. And now, are we going to keep going higher? Maybe. We might be hitting the 8% range. I think that's the next tier that we would stop at, and I feel like that's the highest we would go. The question is, when are rates going to come back down? And clearly nobody knows. Clearly there is no crystal ball for anybody to tell us when interest rates are going to be coming back down. The Fed wants us to believe they're going to stay higher longer so that we act that way, so that we don't start spending a whole bunch of money. And that really means that you need to be prepared. If you are, marrying the house and dating the rate, well, guess what? That relationship with the rate isn't the best relationship, and you might be stuck in it longer than you thought. And so just be cautious about that fact. A lot of people have done temporary buydowns. Those really became popular a year ago. And a lot of those were, 2-1 buydowns, which is 2% off the first year, 1% off the second year, and then your normal rate the third year and beyond. Well, guess what? The first year's ending right now for those people. So their rate and their payment is ticking up. And I know a year ago, I expected rates to be lower this summer. Summer ended 2 days ago. Summer ended yesterday. So it did not happen. We did not see interest rates lower. As a matter of fact, we've seen them higher. So we all have to be careful, because no matter how much we see market cycles and we expect the cycle to repeat, the question of when it's going to repeat is the hardest one to guess. Because if you could guess that right, you'd be a bazillionaire, because you could invest all your money to make sure that you pay out exactly when that happens. And nobody knows that. So just be aware of the fact that the key to home ownership right now is affordability, being able to afford the monthly payment. Now, I'm not saying comfortably affordable, but affordable, a payment that you can actually manage for a few years. Because we could be 3 years at this level. I don't think we will. I think the Fed's being a little bit extra cautious, and I think that we're going to see interest rates come down sooner. But the truth is, I want you to be prepared that you could have this loan for 3 years before you're able to refinance to get a lower rate. So temporary buydowns, although they sound great and they do work, the fact of the matter is they come at a risk. So if you expect to get a pay raise or the ability to make more money in the near future, then definitely a temporary buy down serves both benefits, because it keeps you with a lower interest rate for now. Hopefully by the time that your interest rate starts going up, interest rates have come back down, but more importantly, you're going to have increased income, greater income to be able to afford that payment if in fact you cannot refinance. So that's kind of the gist of what the Fed has said. There's a second topic I want to talk about today, and that topic is what the heck is going on with builders offering super low interest rates. So I had a question yesterday from one of my loan officers asking me about this, and we were talking about how builders are doing it. And then I saw an article yesterday from Lennar that they're offering 4.25% 30-year fixed rates in Colorado. And then last night I was doing my first time homebuyer masterclass. By the way, you should check it out. So it's in my YouTube library if you want to watch that. It was 90 minutes of amazing information about how to deal with bad credit and how to handle buying a home if you have bad credit. And then we went into what's going on in the market, and then we ended with a masterclass on the entire process of buying a home and what you need to know. So check that out. But the bottom line is, I got somebody that asked me last night during that live stream, John, what do you think about these builders, and why are they offering such low interest rates? Is it real? Should we do it? So I want to dive into that a little bit today and help you understand what's going on behind the scenes. These builders are publicly traded companies. It is very much the same as a conversation I had, 3 or 4 months ago on this topic, or on this video, my market update, where I talked about mortgage companies, and the two biggest mortgage companies being Rocket Mortgage and United Wholesale Mortgage, both publicly held. Both are battling to spend the most money and make the least money in order to sell the most number of loans, and they can afford to do that because they're publicly held and they have public money. They have stock investors who basically are saying, look, just grow the top line, and that means create income. Now you can spend more than what you're creating in income and you can lose money. The average business owner can't afford to lose money, because that means that you are basically selling a widget for $100 that costs you $110 to create. Well, that means you're losing $10 every time you sell one. And the more you sell, the more money you lose. So you don't want to sell more of those. That's what mortgage companies, the two biggest mortgage companies, are doing. The 1% down program is an example of that, where we offer it because, well, Rocket Mortgage is willing to give away the money. And so with that 1% down, you've got Rocket is giving you a 2% grant, and they're paying for your mortgage insurance. They're spending anywhere from 3 to 5% of your loan amount in order to get you to do business with them. And that is exactly what these big builders are doing. So what they're doing is they're trying to maintain the price in their community, and they're trying to continue to generate sales. In a high interest rate environment, what's the one thing most people are concerned about? Obviously, it's interest rates. So the builder says, well, hey, if I can't find enough people to buy my homes, then I should just give them a lower interest rate. And the good news is I don't have to lower the price. If you really pay attention, these builders are keeping their prices higher, and they're using that extra income to give you a lower interest rate. Now, maybe that's a good thing, but you got to think of the alternative, which is, wouldn't you rather get the house for a lower price, pay a higher interest rate for a short period of time, because you can refinance later to get a lower interest rate? That's the whole marry the house, date the rate thing. Well, the builders are essentially fabricating what the market's going to look like in a couple of years. They are basically offering lower interest rates, but in exchange, they're maintaining higher purchase prices. How are they doing it? Well, I actually asked somebody in my corporate office yesterday to run the numbers for this 4.25% interest rate. And he said, man, to get to a 4.25% interest rate, it's costing the builder 15 cents on the dollar in fees. So let me give that to you in simple math. If you're buying a $600,000 home and the builder is offering you a 4.25%, it's a 30-year fixed interest rate. What's happening is the builder is writing a check for 15% of your purchase price, of your loan amount, but let's just call it for simple math. So the builder's writing a check for $90,000. I'm not kidding you. For $90,000, the builder is writing a check for you to buy that $600,000 home. And you might say, that's amazing, because now I get a lower interest rate. I get my rate at 4.25% instead of 7.25% or 7.5%. I save 3% per year. Okay, so you're saving 3% in interest per year on your $600,000. So you're saving $18,000 a year. It's going to take you 5 years. I think my math is correct. Well, let's just assume it's correct. Anyway, it's going to take you about 5 years of saving that $18,000 a year to make up for the $90,000 that the builder could have sold you the house for a lower price. Really? And guess what? Your down payment is based on the $600,000. So if you're coming up with 10% down, you're coming up with 60 grand. If they sold the house to you for 510, you only have to come up with 51,000. So not only are you trading a $90,000 lower price for only $18,000 in annual savings, but you're spending an extra, in this case, $6,000 out of pocket that you didn't need to spend. So why are you doing that? Well, it's because it's marketing, and marketing makes it sound good. Now, these are good homes. I'm not telling you they're not good homes, but the other side of the coin the builder is doing is they want to make sure that they don't cause problems with everybody else who already is in escrow and people who are going to be in escrow in the future. Because interest rates, everybody believes interest rates are temporary. They are, meaning rates change every single day. But house prices, they can't play with the house price every single day. And so you got to imagine what the builder's dealing with. They've got hundreds of homes in this community that are under contract for $600,000. And maybe somebody 6 months ago bought for $580 and they've ticked up the price now to $600,000. But the house that they bought for $580 hasn't been built yet. And so now the builder says, well, I really got to give somebody an incentive to buy this home, and I'm willing to give up $90,000. So if I lower the price from $600,000 to $510,000, what's going to happen to the guy that's under contract right now for $580,000? That's right. He's going to call back and he's going to say, hey, I want that $510,000 price, or I'm canceling. And so every one of their in-contract escrows are going to fall out of escrow because the person is going or have to lower the price. They have to lower the price on every single home that they have in contract if they drop the contract price. But the guy who was in contract for $580,000 that already locked his interest rate, and he says, man, can I get that 4.25% deal? No, I'm sorry. That's just a special that we're offering right now. You know, interest rates are temporary. They go up and they go down. And so there's just kind of a special thing, but that doesn't apply to people who are already in contract. Oh, bummer. Okay, well, I understand, but I'm really happy because I got my house for $20,000 less than what you're selling them to other people for. So thank you, Mr. Builder, for building great homes and getting me equity in my home, because clearly these values are still going up. Are they? Are the values really going up, or are they simply propping up the market in order to make their numbers look better? And this also impacts future sales, because now once they drop the price to $510,000, guess what? Now every future sale, like, they can't just jump it back up to $600,000. They have to have incremental increases. And so it costs the builder a lot more money than spending $90,000 on a few transactions. And here's the final piece. A lot of these builders, some of them are offering it to everyone that comes in right now. Some of them are offering it just on one particular home. But they advertise, they market it. Think about car sales. Have you ever seen the ad for that car that, hey, there's a Chevy Silverado that's $9,999. And then in the fine print it says one at this cost, one at this price, base model, stripped down, nothing in it. That's what some of these builders are doing. They're putting out huge advertisements, 4.25% interest rate. And then they say, ooh, yeah, no, the one with the 4.25% interest rate, it's gone. But good news, these other ones, we're selling those at 6.5% interest rates. Now you're thinking, that's still better than my 7.5% that I would be getting if I didn't go with this builder. And so you're gonna buy. But they got the shock value of offering 4.25% to one person. They got the advertising value of marketing it to a whole bunch of people because they're saying one home at this interest rate, and then all the rest of the homes, either they don't give a discount or the smart ones are giving a small discount. So you feel like, okay, it's still worth it because I'm still getting a better deal than I'd get anywhere else. But now they're only spending 25 grand instead of 90 grand to give you that lower interest rate. So gang, it's a shell game. They're moving money around. I'm not telling you I'm not telling you not to buy these new homes. I'm not telling you that you shouldn't go get this low interest rate. As a matter of fact, I'm telling my buyers who are thinking of new construction, don't use me. Look, the builders have deep pockets, and the builders have to keep selling homes. And if interest rates are the things that is the thing that is stopping builders from being able to sell homes, then they'll solve that problem. They'll just pay to get a lower interest rate. And for those of you who understand the mortgage guidelines, you're saying, John, how in the world can a builder give a $90,000 concession or a credit? Because there are limits. Fannie Mae and Freddie Mac, FHA, VA, all of them have caps to how much a seller can pay towards the buyer's costs. And those caps are anywhere from 2% to maybe 3%, 6%. In the best case scenario, 9%. That's a conventional loan that you're putting more than 25% down. You can put 9%. The seller can contribute 9%. So you're saying, John, how in the world is this builder able to get around this? It's simple. Because this fee is not a fee that is negotiated with the buyer. The buyer is not included in this contract. It's a contract between the builder and the bank. And so the builder says, I'm buying a forward commitment. That's the term, forward commitment. And the builder says that forward commitment, I'm allocating X number of dollars, $1 million, $5 million, $10 million of loans at this 4.25% interest rate. What's that going to cost me? Well, it's going to cost you 15% on the dollar. So fine, I'll take $2 million. Here's a check for 300 grand. That transaction had nothing to do with the buyer. And so in the eyes of the legal world of mortgages, that is not a seller concession to buyer's costs. That's a marketing fee because the builder paid a fee for marketing services because they're getting a lower rate to market the home with that lower interest rate. And then the builder can also offer money on top of that to this buyer directly. Those incentives are subject to the caps that are built into the guidelines. So this is really very fascinating. I think that the builders are creating a market for themselves. And I think, look, if you are in the market for new construction, just understand you are overpaying. Like, you're paying more for that home because the builder is trying to keep their price high, and they can. Because if you don't buy with that builder, you've got to pay a higher interest rate. And so most people are looking at the rate and saying, man, I can get a lower monthly payment on this more expensive home and it's brand new. Okay, I'm going to do it. I don't blame you right now. Right now in this market, that's not a bad move. Just recognize they're not giving it away for free. Recognize that as resale home prices are staying softer, builders are making their prices go up. And so the difference between what is a resale home and a new construction home, the gap is widening right now. At some point in time, as resale home prices go up again, new home prices won't go up as much because that gap has to narrow back down to where it was. So you're eating up some of the equity right now that you would be building down the road. Again, you're getting a beautiful brand new home. You're getting a great interest rate. It makes the payment within the budget of what you're looking for. Do it. I'm not telling you not to. I'm just telling you, keep your eyes wide open. Ladies and gentlemen, I really appreciate you listening to me. This Monday night, I am doing a webinar, 7 p.m. on down payment assistance, specifically updating on what's going on with California Dream for All, and providing information on all the other down payment assistance programs out there, because that one, we don't know when it's coming back. I'll talk to you about what things you need to do to prepare yourself so that you're in good shape when it does come back. And we'll talk about some of the things that I think might be changing. So join me if you know somebody else who's thinking about buying a home, wants to know about assistance programs. That's going to be a great webinar this Monday night at 7 p.m. Thanks, everybody. Have a great week, and we'll talk to you soon. Bye-bye.